Welcome back to Mortgagenomics Canada. I'm your host, Marco Gello. I'm a licensed mortgage broker in both British Columbia and Alberta. I've lived in Calgary for many years and have been based in North Vancouver since 2011. If you're in either province and need mortgage advice or services, I'd love to help. You can call or text me directly at 604-800-9593. That's 604-800-9593. One application, one credit check, and access to Canada's top lenders. Today I'm going to talk about Canada's mortgage stress test. It's been 9 years since its inception. Is it impactful as ever, or has it scaled down? Once hailed as a safeguard against reckless borrowing, the Canadian mortgage stress test has quietly shifted into the background of our housing conversation. Not gone, but no longer the headline shock it was when first introduced in 2016. Today it's become one of those can't live with it, can't live without it policies. On the one hand, it acts as a lid on lending volumes, arguably protecting households from over-indebtedness and preserving the stability of Canada's real estate market. On the other hand, it continues to shut out many creditworthy buyers who could comfortably manage their payments at real-world rates today, but are disqualified under the inflated qualifying thresholds of the stress test. This tension between prudence and exclusion defines the stress test's legacy and its controversial role in shaping who gets to participate in Canada's housing market. Let's start with a brief recap. The mortgage stress test has been one of the most significant regulatory changes in Canadian real estate over the past decade. Designed to ensure borrowers could handle future rate increases, this test has evolved considerably since its inception in 2016. So let's start there. 2016 was the formal initial introduction of the stress test, and it was intended only for insured or high ratio mortgages, which is mortgages with down payments of less than 20%. On October the 17th, 2016, the federal government introduced the stress test for insured mortgages. So again, those are mortgages with less than 20% down payment. Borrowers had to qualify at the Bank of Canada's 5-year benchmark rate rather than their actual contract rate. The benchmark rate was calculated as the average of the posted 5-year fixed rates at the big six banks, and it was almost always higher than actual contract rates. At the time, this qualifying rate hovered in the 4.6 to 5.2% range. So even when borrowers were often securing rates at that time in the mid to high 2% range, they had to qualify as though the interest rate was 4.6 to 5.2%. Okay, so pretty confusing, caught a lot of people off track, and not many people even realized what was going on because the rates were so low anyways. And the overall goal here was to curb rising household debt and ensure affordability in an environment that looked like the rates would eventually increase. So move on to 2018. This stress test expanded to all mortgages. So on January the 1st, 2018, OSFI, known as the Office of the Superintendent of Financial Institutions, expanded the stress test to cover all mortgages. So that would mean high ratio or insured mortgages, as well as uninsured or conventional mortgages. So regardless of whether you put 20% down payment, more or less, you were now under the stress test policy. So borrowers at the time had to qualify at the greater of the Bank of Canada's 5-year benchmark rate or the contract rate plus 2%. So this change immediately reduced borrowing power by roughly 15 to 20%. And at that time, I remember it pulled a lot of buyers out of the market like overnight. Then we moved on to 2020. There was a proposed adjustment that was supposed to happen, but it was delayed by COVID. And the Department of Finance intended to announce a plan to replace the benchmark with a more market-based calculation, which would be the average 5-year fixed rate on new insured mortgages. This was meant to create a qualifying rate more reflective of what borrowers actually faced in the market. So once again, this was supposed to come out in 2020, but it wasn't until 2021 when this revision finally came out, and it became the rule for both insured and uninsured mortgages. And basically borrowers had to qualify at the greater of the contract rate plus 2% or the newly established minimum qualifying rate of 5.25%, which still holds today. This change decoupled the stress test from the bank's posted rates, which were often inflated, and created a more predictable and transparent standard. And then on to 22 until today, we basically we're looking at the higher impact from rising rates. So we've been all over the place with the stress test, and here we are today, where it's kind of hitting us from a different angle. As interest rates surged through 2022 and 2023, the stress test became even more restrictive. Borrowers were often qualifying at 7 to 8%, or even higher in some instances, while actual contract rates were already high, 5 to 6%. This further reduced affordability and borrowing capacity during a period of record high home prices. So a lot of people fell out of the market at this time because the qualifying rate just knocked them out of the market. You're qualifying at 7 to 8%. It was just intense. So as you are probably realizing, there's nothing really comforting or good about the stress test, which leads us to today, new purchases. So when you purchase a property, that is a new transaction. That's new money. Therefore, a stress test is applied. Refinances. Refinance is when you add money to your existing mortgage. Okay. This is considered new money. Therefore, it's the stress test. And but here's the key: the mortgage renewals are exempt. So we have many people coming off. They're talking about the renewal cliff, for the past year and a half, and I think we're moving more into another year of the record-breaking amount of mortgage renewals coming due. It is these mortgage renewals. If you are not requesting new funds, then you will be able to requalify based on the contract rate alone, not the stress test. So this is significant because prior to this new revision, people were kind of handcuffed to their existing lender and they couldn't go elsewhere because of the stress test. So now, as long as you're not seeking new funds and you're increasing your mortgage amount, you could now go to another lender and qualify at the contract rate. So this is huge. It's making the environment more competitive, and it allows those people at renewal to go out there and be competitive and get the best possible rate they can for themselves. And heads up, it's as I've been mentioning throughout this episode here, the stress test comes in effect whenever there's new money. So I want to add one more stipulation to this. I've been mentioning throughout this episode that as long as you don't request new funds at renewal, that you will be able to qualify at your contract rate without the stress test. But there is a condition where, let's say when you first got your mortgage, it was just you on the mortgage. You were single, and here you are 5 years later, you are now married. And you want to add your spouse to the mortgage. Okay, so this isn't considered new money, of course, but it is considered a change, which would then trigger the stress test. Okay, so another crazy little rule there to be aware of. If you are making any changes to the land title, that will also trigger that renewal and converting it into a refinance, which makes it stress test qualification. Okay, to give you an idea of how much of a boost the absence of a stress test makes, here's a qualification example that illustrates a stress tested qualification and a qualification without the stress test. So if you're watching this on YouTube, you see a diagram. If you're only listening to the audio version, then just check out my blog version. You'll find the link in the notes, episode notes. So I consider here a household income of $120,000 with a current mortgage balance, let's say, of $500,000 at renewal. Okay, so in the renewal rate, I'm just going to use an arbitrary rate. It's pretty high, of 5.5%. So at renewal time, with a $120,000 annual income, household income, and a renewal balance, a maturity balance of $500,000, I'm using an arbitrary rate of 5.5%. The applicant will be able to qualify and they'll be able to shop around because they're going to be able to qualify at that contract rate of 5.5%. Now, let's compare a total different situation, same income, same interest rate, but you're looking to purchase a new property. Okay, so you're looking at $120,000 income, 5.5%, but because it's a new purchase, it's considered new money and it's now stress tested. So instead of qualifying at 5.5%, you'd be qualifying at 7.5%. And this would drop your qualification, your purchasing power down to $415,000 to $425,000. So huge impact. That's a difference of nearly 75 to 85,000 in borrowing power simply because of the stress test. It's definitely a very impactful policy still today. Since 2016, the mortgage stress test has reshaped how Canadians qualify for mortgages. It was born out of good intentions to safeguard households from over leveraging, but the end result has been it's made things very unaffordable and just very difficult, and it's dropped people out of the marketplace altogether. The key distinction today is this: for new borrowing, purchases or refinances, okay, where extra money is granted, the stress test will continue to apply. For mortgage renewals, so this is when the mortgage stays the same or no changes are made to the title, and so your mortgage does not increase, no stress test is required. Okay, so for homeowners facing renewal, this exemption is one of the few relief valves in Canada's tighter lending environment. It means you can confidently explore renewal options even with other lenders without being held back by artificially inflated qualifying rates. Okay, that's all I got for today. Call or text me anytime if you have any mortgage questions at all, especially if you're in British Columbia or Alberta, as I'm licensed to service these specific provinces, and especially if you are from Vancouver or Calgary, as I'm very familiar with these markets. Come to me for all your mortgage needs. Call or text me at 604-800-9593, or you can get me on WhatsApp, or just go ahead and link up to my website, homefinancingsolutions.ca, where you'll find my complete catalog of past blogs and podcast episodes. And one more thing, check out my award-winning mortgage app. It's embedded somewhere in the notes or profile section from where you are listening to or viewing this. This thing is amazing. It comes equipped with tons of calculators, market interest rates, and every other thing you can imagine. It even enables you to do a snap pre-qualification on yourself. You got to check it out. Give it a try. Thank you again for tuning into Mortgagenomics Canada. Stay well, everyone. Talk again soon.